corporate conversations going. Chennai Petroleum Corporation reported a weak set of Q1 FY25. This was largely led by lower cracks across products. Operating profit margins decline as well. To discuss this and more, we have H Shankar, Director Technical and MD of the company, joining us now. Mr. Shankar, good afternoon. Thank you so much for joining us today. You know, Q1 was weak for the refining industry overall. Can you give us a sense of how much did cracks fall in Q1 across products? And have you seen a recovery now in Q2 in terms of GRMs and refining margins?
Good afternoon, and thank you very much for having me here. It's really a pleasure to be talking to you about the performance of CPCL. We are very proud to be declaring that we have done very well in the Q1. And we have done extremely well on the operating side, and we have reached many records in the Q1 performance. But coming down to the cracks that you were mentioning, I think if we look at our overall product portfolio, almost about 45% is dependent on the diesel. So diesel cracks were roughly hovering around $10 per barrel. So we had a little bit of the issues on this, but looking at the overall scenario of how the cracks have been moving as compared to previous quarters and previous years, I think with the kind of performance that we have had, our operating performance has really given us the good result that we really got this quarter.
Okay.
And I think, yeah.
Mr. Shankar, one more thing what we want to know, we were just asking you about how GRMs panned out as far as the quarter that just went by. How is it looking in Q2? What is it that you anticipate for the rest of the year?
Okay, GRMs, if you look at the overall scenario, CPCL has been consistently performing better than the Singapore GRM, which is considered as the benchmark. And if you look at the overall performance this quarter also, we have done almost $2 more than what the Singapore GRM is. And coming forward, looking forward to the performance, I think if you look at our track record of the past performances, I think we should be able to consistently manage these kind of performance indicators. And we will certainly do well for the company on this.
Okay, so, yes, your margins are better than Singapore GRMs. What are Singapore GRMs trading at right now, Mr. Shankar? Have we seen an improvement? And is there an indication that FY25 will continue to be at these levels, considering that a lot of refining capacity is coming out overall globally as well?
Yeah, Singapore GRM has marginally improved if you compare it with the Q1. There has been a slight improvement on the Singapore GRM. And so is the case with the other product cracks also, which are slightly improving on account of that. So looking forward, we are very bullish on this matter. And we expect that looking forward, I think it's too early now to predict how the financial year will pan out because the cracks have been extremely volatile over the last couple of periods. But we are trying to optimize our operating area so that we can actually do much better on the marginally improving on the Singapore GRM. So we are looking at basically moving towards the operational excellence. That is what our mantra is.
Okay, so Mr. Shankar, you strive to go and, report margins above what the Singapore GRMs are. We got that. Now we want to talk to you about, the JV that you have with IOCL. We understand that IOCL is the majority partner over there. We also understand that from the initial capex that you had envisaged, there has been a cost escalation. So when can we expect the Cauvery Basin refinery to come on stream? And also give us a sense of what is the kind of contribution that you expect from there in terms of financial parameters?
There is a huge gap in the refining margin that is required to be bridged by adding volumes to the refining in the refining sector. And IOCL and CPCL as a JV 75 and 25 by CPCL, we have moved into the CBRPL space. And CBRPL is a very strategically located installation. And I believe that we are now moving towards the final closing out of the necessary statutory approvals. But needless to say, we have also done enough amount of engineering on the project so that as soon as we get the clearances, we should be able to move forward and award these contracts and move towards a closure. We have roughly targeted a 39-month period for completion of the project after all the approvals are received, looking into the pre-engineering activities that we have already started. So I think looking at it, roughly 39 months is what we are starting the commissioning aspect. Because a refinery of that magnitude cannot be commissioned at one go. So it has to be periodically, it has to be ramped up starting from the basic crude units to moving towards the secondary units and moving towards the petrochemical requirements. Also, it's a gradual process. So starting from 39 months, we should be able to begin the commissioning aspect of the refinery. And we are very, very optimistic to it. Yes.
No, yes, of course. That's a huge capacity that you're coming with. What would that do to your debt, Mr. Shankar? Now there has been a cost escalation. What's the absolute debt right now? Your net debt to equity has gone up 2.49 times right now. What is the level that you're comfortable with?
No, actually, we have entered into that project on a debt equity of 2:1. So I think with the current condition that the company is going through on the financials, I think it is a matter of only time that we will be able to sail through on the managing the financials also. Because you must have read from our other portfolio that we are also looking at some other projects at CPCL Manali so that we can de-risk our other businesses and move towards other areas. So we are looking at the kind of, we are comfortable on the financials. That's the reason why we are also looking at major projects coming up in Manali side also, in addition to what we are planning in Nagapattinam.
Thank you. Thank you so much for your time, Mr. Shankar. It was a pleasure having you, and thank you for sharing your thoughts. Let's now slip into a short break. The management of Tangamail Jewelry joins us next to discuss the Q1 numbers and the way forward. Stay tuned.